Hey, welcome back. Thank you so much for joining me in today's video. Corelogic just announced their latest home price index, just announced today, which is actually on April 30th. Their report showed that home prices overall this February rose more than expectations. So looking at investing.com, the S&P Corelogic HPI, or their home price index, for 20 cities, that increased by 0.6% in February compared to the forecast only an increase of 0.1%. Also coming in way higher compared to January's numbers as well. Also, when looking at these numbers on a year-over-year basis, it rose by 7.3%, higher than the forecast at 6.7%, and of course higher compared to the previous month, a gain of 6.6%. They also provided this chart below, which I actually really love this website. The increase in their HPI this February compared to February of 2023 is the biggest year-over-year gain we've seen going back to December of 2022. So before I share their report, I want to provide some context regarding what's the difference between the median sold price on a national level, a common measure of home price changes, compared to Corelogic's HPI. As you guys may know, the median sale price is the middle number. So if the median sale price is at $400,000, this means half of the houses sold for less than that and half sold for more than that. It's only based on closed home sales though. In contrast, Corelogic's HPI is based on the repeat sales method. This is a manner of calculating changes in the sale price for the same piece of real estate. So you look at the sales price for a particular house and look at the previous sale in order to gauge the changes in home prices. It says here that various housing price indexes have adopted the repeat sales method to eliminate the problem of accounting for price differences in houses with varying characteristics. So for example, when you look at home prices based on the median sold price, that's based on houses that closed escrow or sales that were finalized for that month, and comparing that to previous periods. But in my video I made a couple of days ago, I stated how the median sold price on a national level is being influenced by more expensive properties for over $750,000. So when we're seeing more houses being sold in the upper range of the market, that could impact the overall median sold price on a national level. Whereas Corelogic looks at this repeat sales method, and arguably a lot of people would argue that this method is more accurate in order to gauge which direction home prices are headed or have headed. It also says though the repeat sales method is not without its flaws, restricting data to houses that have sold more than twice during the sample period and overlooking the fact the same property can change over time. So for example, let's just say I sell my house. I purchased my house, 5 years ago. It was a cosmetic fixer. My wife and I did a major remodel 2 years ago, and our home value would likely increase quite a bit due to that remodel. So if we were gonna sell our house today, we were getting a lot higher home price because of not only because home prices have increased, but also because of the upgrades we did to our house. So therefore, if my wife and I were to sell our house, the increase in their value since we purchased it is not only a reflection of the market, but also due to the fact we did a major remodel as well. So here's the actual report from Corelogic just announced today, which is April 30th. Hope you guys appreciate these timely updates, by the way. And of course, if you guys get any value out of this video, please hit the like button. Also consider subscribing as well. I post frequent housing market updates so you guys can be more informed. With that announcement or that advertisement, my gripe regarding this report, this is April 30th, and this report is based on their HPI in February. So it's more or less a 2-month lag in their data. On top of that, February's numbers is really a 3-month average for December, January, and February. So it's based on contracts being signed as early as potentially October, but more likely in November, December, and January. So this report for February is really based on when home buyers got their offers accepted in November through January. So therefore, this is very much lagging data And on top of that, when we have this environment in which our housing market is fluctuating big time on a month-to-month basis, and also we're seeing big fluctuations in mortgage rates as well, this is definitely lagging data. Now, having said that, here's a look at the average 30-year fixed rate according to Freddie Mac. This is on our good Uncle Fred's website. So again, when looking at February data, this is November, December, and January. And what you guys see here, rates have been decreasing, especially in December and January. So for example, in November, we're at 7.44%, then it decreased to 6.82% in December, and it decreased once again to 6.64% in January. And as of the end of March, at least so far, according to Freddie Mac, the average for the entire month of April is at 6.99%. So the increase in rates we've been seeing over the past several months is not accounted for in this report from Corelogic. In addition, when looking at daily rates today, according to the Mortgage News Daily for people with great credit, the daily rate, or the average daily rate, is at 7.51%. So again, we have to account for the fact that rates were much lower when this report was analyzing data. But they actually provide some really good context. And again, I'm making this video because I know this is arguably one of the best ways to measure home price fluctuations. They also provided 20 metros in the US and how they fared as well, because there's some very big differences. Only one metro has decreased compared to January, and I'll share the areas in which home prices have increased the most, and also the areas in which home prices have increased the least. All right, let's get back to Corelogic's report. It says in February, their index reaccelerated and recorded a 6.4% year-over-year gain, the 8th straight month of annual increases. So here's a snapshot of that. They have a 10-city index as well as a 20-city index in the US and a national index as well, all increasing by more than 6%. On a national level, it increased by 6.4%. What caught my attention regarding this is that we're not seeing the giant increases we saw in 2020 as well as or through the early parts of 2022. But the year-over-year gains is actually higher compared to the most part during pre-COVID levels. On a national level, here's a look at their index as well. The index right now is at 312. This is higher compared to 2022's peak at 308, but at 312 right now, this is still lower compared to the late and also the early fall months 2023. It's also about 53% higher compared to February of 2019 as well. Going back to the report, they also touch on the increase in their HPI from January to February and how that compares to years past as well. While high rates continue to impact sales activity, the non-seasonally adjusted month-over-month increase jumped by 0.6%. Considerably higher than the 0.2% increase recorded between the average between 2015 and 2019 in February. So this month compared to January, their HPI rose by 0.6%, but the average January to February change, looking at pre-COVID levels, only increased by 0.2%. Even last spring, when home price growth heated up beyond the seasonal trend, February's monthly increase was only 0.2%. This month, an increase of 0.6%. So here's a chart showing just that. The month-to-month change, a gain of 0.6% right now. This is not negative, it's a gain of 0.6%. This is higher compared to the 2015 through 2019 average, only a gain of 0.2%. Obviously, it's lower compared to 2022 and 21, but higher compared to pre-COVID levels. In addition, in February, 19 of the 20 metros they track saw faster price growth year over year compared to the previous month. So take a look at this. For the 20 metros that Corelogic tracks, when looking at their HPI this February compared to February 2023, San Diego led the nation here, at least for these 20 metros, up by 11.4%, whereas Portland, Oregon only increased by 2.2%. That was the smallest increase on a year-over-year basis. We also saw big gains in Boston, Charlotte, Chicago, Detroit, Los Angeles, Miami, and also New York City, all increasing by 8% or higher from 1 year ago. Additionally, when looking at changes from January to February this year, there was only one metro that decreased. That was actually in Tampa, Florida, a decrease of 0.3%, whereas Seattle, Washington saw the biggest gain, up by 2.3%. That's quite a bit higher compared to the national average, a gain of 0.6% month to month. Also, this 11.4% gain in San Diego is nearly double the rate on a national level at 6.4%. Like I always say, real estate is local, which is pretty astonishing given the fact these big variations. Look at Denver, only increasing by 2.7%, whereas San Diego, the average home price around $1 million increased by 11.4% in one single year. So let's look at the market in Portland, Oregon compared to San Diego really quickly here. So this is according to Redfin's data center. The number of new listings in Portland, and this is actually much more updated numbers, but just in general, looking at the 4 weeks ended April 21st, the most recent data we have from Redfin, new listings increased by 9.1%, whereas pending home sales actually were more or less flat from 1 year ago, only increase of 0.7%. So despite the fact there is about 9% more new listings compared to last year, pending home sales are flat on a year-over-year basis. Let's look at active listings as well. Look at that. Active listings at least a 3-year high during this time frame. And on top of that, increasing by 12.7% from this time in 2023. In addition, the share of price drops also skyrocketing as well, at least a 3-year high during this time frame as well at 7%, reducing our asking prices. And lastly, let's actually look at a couple more things. Average sale price to final list price ratio, also at least a 3-year low as well. On average, houses selling for the asking price. Compare that to the craziness in 2022. Houses on average were selling for 5% over asking. Now they're selling for the asking price on average. That is a lagging indication of housing market though. Let's also look at the median sold price in Portland, Oregon. Look at this, nearly a 2-year low for this time frame. So right now, the median sold price is at $554,000. At this time in 2022, also $554,000. This is also only a 4% increase compared to 1 year ago. In contrast, let's look at San Diego. Again, the biggest increase of these 20 metros. New listings increasing by 15%. That's pretty astonishing. Whereas pending home sales at least a 3-year low during this time frame. Active listings. Let's see if active listings are a 3-year high. No, they're not. They are up by 22% year over year, but still lower than 2021. Also looking at the average sale price to final list price ratio in San Diego, on average selling 1% over compared to 2022, about 6% over asking on average. And lastly, the median sold price in San Diego up by 9% year over year at $913,000 right now. Look at just 3 years ago, we're looking at only $726,000. Now it's over $900,000 right now. And lastly, here's something I found to be really interesting as well. I love it when real estate sources or companies share the trends we're seeing right now compared to pre-COVID levels. So they actually looked at the 20 biggest metros and also on a national level, how's it compared to the average January to February change from 2015 through 2019. So Seattle, the month-to-month change, January to February, increased by 2.3%, whereas on looking at pre-COVID levels, we only increased by 1.3%. So also in San Diego as well, it increased by 1.7% this February compared to January, whereas the historical average, looking at pre-pandemic levels, it only increased by 0.7%. So in Seattle and San Diego, home prices increased about 1 percentage point higher compared to pre-COVID levels. And we're seeing that really across the board. There's only a couple metros here that are experiencing smaller gains compared to the average pre-COVID levels. But in San Francisco even, look at San Francisco, increasing by 1.7% compared to the 1% gain we should be seeing. And also we're seeing big gains in Portland, Washington, D.C., Los Angeles, Chicago, Boston, as well as Denver as well. Actually, in Denver, we're seeing the same price increases compared to pre-COVID levels, but most of these metros are experiencing big gains this month compared to the historical averages. In contrast, in Phoenix, Arizona, we saw smaller gains compared to pre-COVID averages. And we're seeing the same thing in Atlanta, Georgia, and Charlotte, as well as Miami, and especially in Tampa, Florida. This month, it fell by 0.3%. Historical averages should have seen a gain of 0.4%. And with that said, please comment below with your biggest takeaways from today's video. If you guys got any value out of today's video, then please hit the like button. I greatly appreciate that. Of course, consider subscribing as well. Also, if you guys want a real estate agent referral, check out my website, which is realestateteamfinder.com. Hope you guys have an awesome day. Look forward to seeing you on the next video.